Okay, let's talk about the review of accounting, which is the chapter preparing for the following slides. I bet you've already learned accounting before, but as far as I know, a lot of people just forget everything that the professors taught them after the final examination. So I think there is a necessity for me to help you briefly review the very basic knowledge of accounting. This is not the accounting course, but accounting is very important in corporate finance. What is accounting? And we're going to review all the real world filings, and we briefly review the income statement and the concept of price earnings ratio and the balance sheet, cash flow statements, and we discuss briefly the limitations of the financial statements. So what is accounting? Accounting provides financial information about a business, or it can be called a business language. If you don't know accounting, it's very hard for you to run a business. At least you need some partner who can help you review the financial condition of the business. If you understand accounting by reading the filings, by reading the financial statements, without even participating into the real operation, you can basically get a general idea about how this business is doing. As long as the accounting information is authentic, it's true. Okay, so based on the real accounting information, outside investors, analysts, shareholders can know better what their business is going on. So of interest to stakeholders in business, they include shareholders, managers, creditors, governments. All of them want to know your business information. So all of them want to read a careful report from your company. So the information is used to make decisions about the business. Financial statements summarize accounting information, and they include the three most important ones that we just said before. I find that in the last years of teaching, I unfortunately find that some students, even though they've learned accounting and they finished the college accounting class, they've never read real filings, okay? And they don't know where to find them, which is, I think it's unacceptable. So I have no idea what's going on. But I would like to show you some filings in real world so you know that where to find them and where the businesses, the corporations are submitting these filings to. For example, for the basic financial measures in Yahoo Finance, they're reported in Yahoo Finance, Google Finance. A lot of, if you look at each different countries like Indian corporations, Chinese corporations, you can look at their own financial websites. Some professional financial websites will summarize these financial measures, indicators from their filings and summarize them and show you. For example, you can go to Yahoo Finance to find AAPL. AAPL is stock ticker for Apple Inc. Okay, you can find the key statistics of that. It will show you the SEC filings and ownership and etc. Like this. Okay, if you just enter here, this is a search box. If you just search AAPL or Apple Inc., it will show you the market cap. We explained this a little bit in the past in the lecture video that we talk about the stock pricing and stock market. Okay, so we do not talk about them here again. So it will show you the market cap, enterprise value, trading. Usually it's 12 trading month, and forward PE. Okay, and price sales ratio, price book ratio, and the fiscal years. There is a difference between calendar year and fiscal year. So calendar year starts from January the 1st, just ends on December, the last day of December, December 31st. But fiscal year is based on when you file the annual report, so it can be different across different countries. It will also report the profitability, the profit margin, and the stock price information, like 50-week stock price range, high and low. Also, it will show you some calculated financial indicators, including ROA, or return on asset, ROE, return on equity, and the information in the income statement, like revenue, quarterly revenue, gross profit, EBITDA is earnings before interest, taxes, depreciation, and amortization. Okay, diluted EPS, earnings per share, and the quarterly earnings growth. It also shows you the information in the balance sheet, for example, the cash and cash per share, debt or liability, and the current ratio. Okay. It also shows you some information from the cash flow statement, that the three important cash flows from operation, from investment, from financial activities. And it also shows you the stock splits and the dividend payments for the stockholders. And these information, these statistics, they are summarized from the financial statements that the firms reported to the regulatory agencies. In the U.S., they reported to SEC. Okay, in China, in India, they report to also to the government, and they also made them. The listed companies also make the annual report public on their company websites. Okay, usually. So from Yahoo Finance, you can also download the real filing that they filed to the government. So here is the summarized statistics for you to read by Yahoo Finance. But Yahoo Finance also guides you to the government filings. I mean the corporate filings to the government. So for example, this is consolidated balance sheet. Why it's called consolidated? Because the company could probably have some branches. It has some, the parent company can have some other company that they are holding. They have the ownership of the other companies. So the consolidated balance sheet will comprehensively calculate the current assets, for example, the goodwill, calculate the goodwill, current assets, cash, and everything of all the companies combined. Okay, and this shows from 2014 to 2015 the change of different items under the current asset. What is a current asset? What is a long-term asset? Current asset means a short-term asset. It means everything you have in the current operation. The long-term asset is called capital. Okay, capital. And the total assets, we can see that the total assets increased from this number in 2014 to this number in 2015. And in the balance sheet, we know that in the balance sheet, it's asset equals equity, liability plus equity. Okay, what is left? What do you own is assets. So asset means that all the resources that you own. You can control, and you can use this money, these resources, no matter they are what you own or what you borrowed from. Okay, so for example, I have $1 million, $10 million, my $9 million I borrowed this money from other people. So $10 million are all my assets. Your assets can be high, but your equity may not be high. Only the $1 million that you own is your equity. $9 million for the $9 million you borrow from the other people, for example, a bank. So you can control this money. You can use this money. You can use this money you can input this money to your into your operation, or you can use this money to buy some stocks or other investments. You can use this money. Everything that you can use, you can control, is your asset. But the part that you borrowed from others is called liabilities. And the real ones that you really own is your equity. What is more important, equity or asset? Well, different people have different opinions. I personally think assets are more important because although the money is not yours, but this is what you can use for. And actually for the corporate managers, assets are more important than equities because the equities are owned by the shareholders, while the CEOs could probably own some very small portion of the shares of the company as a manager to, if you still remember, to minimize principal agent conflict. But the equity is cannot be enjoyed by the manager on most occasions. But for the assets, you can use the asset, even though it's a liability, it's money that this company borrows from a bank. You can use this money to decorate a very nice and luxury office for the CEO and CFO, right? So this is money that the management team can enjoy. Think about another one, and from Yahoo Finance, you can also access EDGA. EDGA is a database of SEC, the U.S. SEC, that stores all the financial statements. For example, this is the Form 10K. So in the U.S., the annual reports, annual reports are the most important financial statements that the listed corporation must provide, must submit. So they usually submit two kinds of forms, either 10K or 20F. If this company is headquartered in the U.S., it's a U.S. company, then it files 10K. If it's the foreign company, for example, a Chinese company, New Oriental Education, it files 20F. Okay, they're basically the same. The different forms are just for the companies in different countries. In the U.S. or in the U.S. they call it U.S. firms or international firms or non-U.S. firms. Non-U.S. firms will be filing 20F, Form 20F. So you see that from the 10K, they have different items. The introduction of this company, a brief description of your, description, basic description of your assets and your strategy. And here you can see that the item 8, financial statements and supplementary data. It has the income statement, balance sheet, stockholders' equity, cash flow statement, and other things. Okay, and there is a report of Ernst & Young. It must be auditing reports, and also includes other things like executive compensation, directors, other things. The annual report is called 10K for U.S. firms, and the quarterly report is called Form 10Q. Okay, 10Q. It has a description of the business. It also have a lot of other materials. If you want to directly go to the U.S. government website, it's a U.S. SEC website. It has, and access the submitted filings from the corporations to the governments. You go to EDGAR. It's from the sec.gov. So it's a U.S. government website and /EDGA. Okay, some people call it EDGAR. I don't know. You will go into this website and you enter the stock ticker or the stock name, for example, AAPL for Apple, and you search. You will have a list of different filings. Then you click 10K. You will get to Form 10K. And here, the Form 10K, this is the first page of the annual report, and it has a logo of this company's name, and incorporation place, and it's incorporated in California, and it's the IRS Internal Revenue Service, services. It's basically the Department of Tax Revenue for the U.S. government, and it's employee identification number, and from this number it can it pays taxes. Okay, and in this file you will find the balance sheet Okay, and you can see that the total assets, the current assets, both the current the current assets of Apple Inc. increases from this number 131,000 million. 1,000 million is billion. So $131 billion in 2018 to $162 billion in 2019. You know that the total asset increased by $31 billion and more. While the non-current assets decreased a bit. Actually decreased a lot, and the total assets actually decreased. The total assets decrease may not be a very bad thing if we need to look into the details. Maybe it's because the liabilities went down. So you see that the liabilities went down a bit, but also the total liabilities went down a bit, but also the equities also went down. So this is not a I'm not sure. Like this may not be a good thing for the shareholders. But we need to look at the other things. For example, the government is doing a lot of investment, or is just paying. Maybe it has some strategy, investing in a lot of R&D, research and development. Maybe it's researching the next generation iPhone. I don't know. So in Hong Kong Stock Exchange, you can go to the HKEX listed, and this website you can find out. For example, you click on the link, you can get the ICBC's annual report and the other financial statements. And the stock ticker, stock tickers in the U.S. are letters. Okay, for example, Apple is AAPL, but stock tickers in Hong Kong and mainland China are numbers. So HKEX News will give you a lot of different filings, and from this is a website, and you click the ICBC, you will find all of the ICBC's filings, the documents, and if you click into the annual report, it will give you this 2019 annual report, and this is also a consolidated statement of the financial position. It's just another name for the balance sheet here, and you have the total assets increased from so this is in RMB millions, so this is 27 million. So 27 million is 27,000 billion. What is bigger than billion? Trillion. So 27 trillion increased from 27 trillion to 30 trillion. Am I right? Trillion, right? It should be trillion. Yeah. So it made another 2.3 or 2.4 more trillion dollars. Trillion RMB. Okay, that's a lot of money. So you can also see that the liabilities also increased a lot. Okay, also increased a lot. The liabilities also increased by 2 trillion RMB, and the equity is also increased by. So basically, this number minus this number should be 350 billion RMB. Okay, you can see that they report the total assets here and the total equity and the liabilities here. The two numbers must be the numbers in the two rows must be equal. Okay, must be equal because assets are equal to liabilities plus equity. In Chinese language, the filings in Shanghai Stock Exchange, you can also see that this is it says annual report, the first quarter report. It's the semi-annual report and the third quarter report. Okay, and if you search the China Merchants Bank, and you find that 2020 semi-annual report. It's 2020 semi-annual report. Why is the font so cute? Okay, so this is a total. This is a Chinese for balance sheet, and this is the assets. And you see that all different items of the assets. And this is goodwill, and this is cash and cash equivalents. Okay, and for Singaporean firms, you can go to this website. Also the Singaporean government or exchange website, and it has a Chinese here, it has English, and you click the annual report, you can see the Singapore Airlines annual reports in the FY for fiscal year 2004 from 2019 to 2020, and you can see that this is also it should be the balance sheet, because this is equity and this is liabilities. It doesn't really look like it, but I don't know. I think it starts from 13 probably. Before this, there was another page for the total assets. And you can also find the corporate filings from the company websites. For example, if you go to the HSBC's websites, you will find that this is last 4 quarters, company earnings release, annual results, and you can download them and take a look. So in 2015, the first time I was teaching this course, the rank of the stock exchanges by market cap, so it's the market capitalization or market value, which is equal to the total number of shares times share price, stock price for each firm's market capitalization, and you sum up all the listed firms, companies' market capitalization, you get the market capitalization of the stock exchange. So NYSE is the largest stock exchange in the world, followed by Nasdaq, the Japan's Tokyo Stock Exchange, London Stock Exchange, Shanghai. And in 2019, the stock exchanges market capitalization rank changed a little bit. I'm sorry, this is not Tokyo. It's Japan Exchange Group. Okay, you see that Shanghai is getting above London. London is getting down, and Shanghai is greater than is above Euronext. Is above Euronext, above Hong Kong. So hey, London actually dropped a lot in the 4 years between 2015 and 2019, and So London is followed by Shenzhen, and Shenzhen is followed by Toronto, and India is coming up. Okay, India is coming up. Then it's Germany. Okay. So we just talked about where to find the filings in the real world and what they look like. Now we do a little bit review about the different financial statements. The first one is income statement. So income statement is basically revenues minus expenses equals net income. Okay, revenues are the revenues from customers for services or merchandise, and expense from vendors for these merchandise, services, or supplies. It can be prepared in steps. So basically, the income statement is like sales minus cost of goods sold. For example, if you're selling shoes, then you have to use some raw materials to make shoes, right? Like the plastic, this and that. And all of these cost for producing the product or services are called cost of goods sold. So you minus this cost of goods sold, you get the gross profit. Why is it called a gross profit, not just the profit? Because you have not considered the management expense, operating expense. For example, you have to hire some people to deal with this account. You have to hire people to file the annual report. You have to hire some people to deal with the tax issues, and you have some salespeople. Okay, not just because the cost of goods sold are just for the cost of making this product directly, but you still have the salespeople, you have the managers, you have all of this. These are the operating expenses. You subtract the operating expenses from the gross profit, you're left with the operating profit. Okay. Most occasions, operating profit is very similar to a concept or equal to, or just equivalent to another concept called EBITDA or EBITDA. EBITDA is earnings before interest expenses, taxes, depreciation, and amortization. So the next steps are subtracting each of the four things from the EBITDA, and you will get EAT, earnings after taxes. So you subtract the earnings expenses from operating profit or EBITDA, and you get the earnings before taxes, and minus the income taxes, you get earnings after taxes. Actually, you have another item to subtract from, which is depreciation and amortization based on the accrued basis of GAAP. But we will talk about that later. Here, see that sales minus the cost of goods sold, you got the gross profit minus the selling and administrative expense, selling the amortization expense. Okay, then you got gross profits minus this. Okay, you will have the EBITDA, and EBITDA is EBITDA minus amortization. Amortization is A. Sometimes it also includes D. So EBITDA minus DA is EBIT. Okay, EBIT is operating profit. I'm sorry. So here it should be operating profit should be EBIT, not EBITDA. Okay, or operating profit plus the amortization expense should be EBITDA. So EBIT minus the interest expense, you got the EBT minus T, you got the EAT. Then you also need to subtract the preferred stock dividends from the EAT. Then you get the earnings available to common shareholders. So this is the total earnings, the net income. Okay, the net income divided by the shares outstanding, you will get the earnings per share. Okay, earnings per share. In the last video, we explained the PE ratio in the lecture video of the stock pricing and stock markets. So we just briefly review this. PE ratio is market share price divided by EPS, and it's a measure of desirability of the stock. If a company's stock ratio is if a company's PE ratio is higher than the other one, that means that stock is more preferred by the market investors, because given the same EPS, given the same earnings per share, the market investors would like to pay more for the first stock because they offer a higher stock price. So that means these companies, they desire a higher, they have a higher desire and demand for the high PE ratio stock. Balance sheet. So the second one. Balance sheet is a snapshot of this company's asset structure. It shows what the firm owns and how it is financed, and how it is financed at a point in time. For example, the last day of December. Remember the ALE relationship: assets are equal to liabilities plus equity. Classifications on the balance sheet. So assets are what a business owns. Okay, actually it's what a business can control. And liabilities are what a business owes. And equity is what a what the owners have invested in the business. So what the owners really have. So equity is a net, sometimes it's called net asset. Okay, net asset. Because assets like a gross asset includes the money and resources that you borrowed from the other institutions. And assets have current assets and capital assets. So current assets is a short-term asset. For example, accounts receivable or inventory. So these are the things that you can get or you're going to get in a short time. So they will be sold or used up within 1 year. These are called current assets. Current assets are used in the operation, the daily operation. Okay. Capital assets, you cannot say that capital assets are not used in the daily operation because, for example, the factory buildings, they're used, but they can last for a long time. So be careful about the words that I'm using. So current assets will be sold or used up. So to used up. So they will be used and it's gone within 1 year. Liabilities also have two categories. The first one is current liabilities or short-term liabilities. The second one is longer term, the long-term liabilities. Usually they due sometime after 1 year. The equity includes the capital stock and retained earnings. Okay. So assets are listed in order of decreasing liquidity. So usually the first one is cash, and then the restricted cash, then to other assets, current assets, then to long-term assets. So liquidity means the ease of conversion to cash. Or it basically means how easy this asset can be transacted in the market. For example, you have a, like say, jade. Okay, jade is precious. But you cannot say, hey, I want to sell your jade. Do you want to buy it? It's really hard for you to find a potential buyer. Harder than if you hold a Apple Inc. stock. If you hold an Apple Inc. stock or Tencent stock, then you can just click sell. Then right away on the market, within 1 second, you're going to sell this stock. But you don't have a place where you can sell the jade within 1 second. So we say that Tencent or the Apple Inc. stock is more liquid than jade. Okay, and jade is probably more liquid than a real estate property. But a real estate property in a big city is probably more liquid than a real estate in a very remote countryside. The harder you find the potential buyers, the harder you sell the assets, the less liquid this asset is. Okay. For example, this is KRAMER Corporation balance sheet. You have the current asset, and the first one is cash. The second one is marketable securities. Securities can be sold. It can be sold quickly. And this is accounts receivable. So accounts receivable are the notes denoting what other people are owing you. For example, you have sold your goods. You have sold your goods to your customer, but the customer currently just have a shortage of cash. So the customer is saying like, how about like I just purchase your shoes first, and I'm gonna pay you the goods money, the price in 1 month. So now I'm writing you a note, and that note is called accounts receivable. Remember that accounts receivable are marketable. I mean, they can be transacted. For example, B buys a product from A, and B writes a note to A saying like B will pay this price in 6 months. So A is holding this accounts receivable note, and A can actually sell this note, this account receivable note, to C, and C can hold this accounts receivable note to come to B. Say, hey, I've already given money to A, and how about you just give the money to me? So B will get back the accounts receivable notes and pay money to C. It can be transacted in the market. And then inventory, then prepaid expenses, then you got to other assets, like short-term investment. Then you go to capital assets, like plants and equipment. Sometimes we call it PPE. Okay, PPE, plant, property, and equipment. And we have liabilities and shareholder equity that we actually talked about the other examples. Here is a very important concept that you must be familiar with. This is net working capital. So this concept will be used in the other chapters a lot. At least 2 chapters you'll be using it. Net working capital is the difference between the total value of the asset and, the net working capital is the difference between current asset and the current liabilities. So like in the operation, the current asset minus the current liability, because they are both short-term. It's a short-term equity that you have. Okay, why do we have the net working capital? Because you always need to have some money there to support to make the business run. For example, if you have a clothes shop, okay, selling female clothes, you must have some, say, cash in the receptionist counter, not the receptionist counter, at the counter. Okay, you need to have them cash there, because when other people buy the clothes and they give you money, you have to give them changes, and that can be the net working capital. So this is, just remember that this name is very vivid. It's a net. So the net is a net for the difference between the current asset and current liabilities. And it's a capital. It's a money. It's a money that makes the business work. So it's called net working capital. Okay, this is for the whole business, the operation work. So it's usually positive, okay, in a healthy firm. Okay. It's positive when the cash that will be received over the next 12 months exceeds the cash that will be paid out. We talked about liquidity, and firms are facing a trade-off to find the balance between liquidity and liquid and illiquid assets, because usually illiquid assets have higher risk, so they have higher return. Okay, but liquid asset can help you when you are in trouble. For example, like you just need money for your business. For example, like you have a big customer and say, hey, I want to order a lot of products from your company, so now produce it. You want to produce it, so you want to buy more equipment, but you don't have cash because you have used your cash to buy some illiquid assets, and you want to turn these assets into the cash and use this cash to buy more equipment. You cannot do this. So liquid asset can help you to finance when you are in the financial distress or in the conditions when you really need cash, when you really need money. But liquid assets generate lower returns. So firms always face a trade-off between the easiness to convert to cash and the higher return. Therefore, between the trade-off between liquid and illiquid asset. Cash flow statements. So the cash flow statements include the cash flows from operating activities, financing activities, and investing activities. Operating activities are pretty easy to understand because it's just like when you are producing shoes. Okay, you use money to buy the raw materials. It's cash outflow. and you sell the shoes to your customers, and your customers buy your shoes using their money. They give the money to you, and this is your cash inflow. So these are all cash flows, inflows or outflows from the operations, right? From the operations. A lot of students are confused about the investments and finance. The investment activities and the financing activities, okay? Financing activities usually involve the buy and sale of your own company's shares or financial assets. For example, if you want to borrow money, you sell your bonds, or you issue more equity to the bond investors or share investors, and they will give money to you, and this is your cash inflow from the financing activities, okay? And you can also repurchase your own stocks, and you will spend money to repurchase the stocks, or you can call the bonds back. Remember the callable bond, and you buy the bond, your own bond back, and this is cash outflow. All of these are in the financing activities. For investments, it's like more investing your money into the real plants, or you buy the other company's plants, or you buy the other company's ownership shares, something like that. Okay, these are different. If you buy the other company's stocks or bonds, these are investments. If you repurchase your own companies and retire your own company's stocks, this is financing. So this is an illustration of concepts behind the statement of cash flows. So cash inflows. For the operating activities, the cash inflows include the generation of funds in normal operations, and cash outflows including the expenditure of funds in normal operations. The cash flows from investing activities include the sale of plant and equipment and liquidation of long-term investments. The cash outflows include the purchase of plant and equipment. And financing activities include the sale of bonds, common stocks, preferred stocks, and other financial securities. And cash outflows include the retirement of these financial securities. Okay. And here's a list of steps in computing cash provided by operating activities using the indirect method. For example, use the net income plus. So basically, you're getting this back. So you remember that net income or net profit is earnings after tax, is EBITDA minus interest expenses, minus the taxes, minus the amortization, all of this. Remember the amortization and depreciation, they're not really, they're on GAAP, the accounting standard, US accounting standard, based on accrual basis. When you buy a $10 million equipment, and you assume that you expect that you can use it for 10 years, then based on accrual basis, every year you need to deduct $1 million for using this equipment. It's like after 1 year, the market value of this equipment is reduced by $1 million. But actually, this is a hypothetical assumption. You do not really spend $1 million, right? You spend $10 million to buy this equipment. So you assume that in the next 10 years, every year, you lose $1 million. But you do not really lose $1 million cash. from your pocket. You don't have it from the pocket and throw it away. You don't do that. That's why that amount of money should be cash, should be added to the net income. Okay. And the increases in and decreases in the current assets and increases and decreases in the current liabilities need to be adjusted based on the net income and plus amortization. And therefore, you will have the cash provided by the or used in the operating activities. Here's a corporation again, and you see that you have the net income, amortization, and cash flow from operations. You can calculate all of this and get the cash provided by the accounting activities. Again, this is a corporate finance class. We are not going to the very detail about these financial statements. We're just to help you recall what you learned in the accounting course. So these will not be tested, but they will be used in the later chapters in talking about the calculation of NPV of a project, net present value of the project. Okay. So there were some limitations of financial statements. First, it's based on the past transactions other than the future forecast. It's more like a review. Okay. On the annual report, you can review what this company, what the business has been doing. Was it doing well or was it doing not so well in the past year? It's like a review. It's like a transcript. Okay, but you cannot really focus its future that much. Well, if you can see from the annual report that this company has a lot of money, it claims that it's doing very well, then probably it's going to do very well, but not really. Think about Nokia. Very young generation probably never heard of this brand, but Nokia was the largest cell phone, if I remember right, it was the largest cell phone maker and seller of the world. And around that time, its financial statements looked fantastic. They looked fantastic. But after Steve Jobs, invented the iPhone, or led the team and invented the iPhone, the smartphones, and Nokia just went into deep financial trouble. So you do not really know. It's like you look at the student and you look at his transcript, and as a student, what did you do? Did you do it well? You look at the transcript and say, hey, he's been doing very well. He learned a lot of things in the past year. But does it really say anything about the future? Probably a little bit, but not really all of his future, his or her future. Maybe next year he's doing some really fantastic things and become a very great person in the future. Maybe for some very good students in terms of their transcript, their grades in the past year. But that things, starting from this year to the future, he's not really doing a lot of meaningful things. And his future probably is not that promising. So all of the financial statements, they're based on the past transactions rather than the future focus. So you really don't know the future that much. I may not recognize important economic changes as they occur. For example, the increase in property values or a new competition. For example, you probably can see, this is related to the first point, that you do not see everything about the future for this company from the financial statements alone. Because, for example, he's doing very well, but you never know that maybe in his financial statements he will mention that, hey, we have a new competitor, but when you look at this new competitor's financial statements, you find out, hey, this new competitor is not making a lot of money. But what you don't know is this new competitor is inventing a brand new technology that will change the whole world, which will eventually make this current corporation you're looking at meaningless, totally marginal in the future. But you don't see that from this corporation's financial statements. There is also a variety of accounting policies and methods are used. For example, the amortization, inventory valuation. That means in different countries, for example, in US they use GAAP, in Europe they use another accounting standards. So for example, when you have the same goods, okay, So the same goods in the inventory, but they're purchased from this different times, at different prices. Then when you use some of, not all, but some of the goods to produce your products, the raw materials, which price do you use? Okay, in some accounting standard you use last in, first out. In some other accounting standards, you use first in, first out. So that means if you purchase two things at different price and you use one, in one accounting standard it says you use the price of the good that you purchased for the first time. This is the first in, first out. And in another accounting standard is saying you use the price of the goods that you purchased the last time. So this is the last in, first out. So why does it matter? Because if you use a different prices, it means a different expenses. Maybe you use one price, your final net income, your profit could be positive after the whole calculation. And when you use the other price, the profit can be negative. So according to, because we have different accounting standards, and there were different regulations. Another thing is depreciation. Like what kind of depreciation methods you want to use. If you use different depreciation methods, you probably will get different profits, even negative versus positive profits for the same company. So you don't really see everything very accurately only from the financial statements. These are the financial statements limitations, but they are still very important because accounting is a business language, and when it's more than better than nothing. If you read the financial statements, you can largely know what a business is doing. Okay, but you don't know 100%. Okay, there were some summary and conclusions. There were some three basic financial statements: the income statement, balance sheet, and the statement of cash flows. And we also reviewed a little bit about the price-earnings ratio, P/E ratio, and there were some inherent limitations. That's it, and thank you very much for listening to this lecture. I'll see you next time.